So with that, this is my standard disclaimer, okay? All right. So I'm looking forward to hearing a great deal about the effects of the ECB's recently announced QE program on the euro area economy. And Eric Rosengrun will be talking about the effects of QE on the U.S. economy and what implications that might have for the euro area. What I would like to do is kind of like step back a little bit from that and kind of like look at the international dimensions of monetary policy and quantitative easing. As you know, as suggested in the graph here, the United States and UK economies have been recovering a little bit more briskly than those of the euro area and Japan. As a result of that, market expectations are for interest rates in US and UK to be taking off at some point not too long from now, whereas the expectations are for interest rates in the euro area and Japan to stay quite low. By the same token, the Bank of England and the Fed have completed their asset purchase programs, whereas BOJ's asset purchase programs are still ongoing, and those of the ECB just getting started in a big way. Actually, this is my old slides, but whatever. Anyway, in the context of this, situation of divergences in monetary policy, it's attracted a lot of attention, and a number of the questions are being asked. First of all, will QE in the euro area, along with ongoing QE in Japan, is that going to basically complicate the task of those central banks that are intent on normalizing their monetary policies sometime in the next year or so? And then a second question, and sort of like the converse of that, is if the Fed and the Bank of England and other central banks are normalizing their monetary policies, is this going to diminish or complicate the effectiveness of QE in Japan, the euro area, in terms of establishing their economic recovery goals? So to answer both of those questions, you have to have a view on how quantitative easing or monetary policy easing more generally spills over across borders into other economies. And in order to address that, what I'd like to do is talk a little bit about how the Federal Reserve analyzes the cross-border effects of its quantitative easing policies. Now, as you doubtlessly are aware, the Fed's QE has been criticized in some quarters for being beggar thy neighbor, for boosting U.S. domestic demand, but at the expense of foreign economies. I disagree with that, and I'll kind of show you why. So here on this slide, I've identified three different channels by which U.S. QE spills over into other economies. The first, quite standard, lower interest rates, are caused by our asset purchases, boost stock prices, boost U.S. domestic demand, boost our imports, and thus help foreign economies. The second channel, through the dollar, is an offset to that, as the lower dollar basically boosts our exports, switching expenditures from the rest of the world to the United States. And then finally, a third channel that's achieving more prominence of late is what I'm calling financial spillovers. Lower U.S. interest rates through portfolio balance channels push down interest rates and push up other asset prices abroad, boosting domestic demand in other economies and thus helping those economies. So to provide a sense of how that actually all plays out in practice, what I'm showing here are the results of a DSGE model simulation using the Fed's open economy model of the effects of U.S. asset purchases that might push down U.S. yields in the neighborhood of 25 basis points. I'm showing these graphs in deviation from baseline form. And in this particular experiment, I am not even accounting for any of those financial spillovers I talked about before. We're only looking at the interplay of domestic demand effects and dollar effects. And so what you see in this experiment is the effects of lower interest rates push up domestic demand, pushing up U.S. GDP, the top left panel. At the same time, there's some not huge depreciation of the dollar. That's the bottom left panel. That leads, looking at the bottom right panel, to an increase in imports, the purple line, because U.S. domestic demand rises, some increase in exports, the green line, because the dollar has fallen. But the net of those is that net exports for the trade balance actually falls a little bit below zero, as the domestic demand effect has offset the currency effect, leading to basically no change in foreign GDP. Now, that, as I said before, is without any of the financial spillovers. But we know from a lot of research that U.S. monetary easing actions do lead to spillovers to other financial markets, probably, as I mentioned before, through these portfolio balance channels. Okay? So now we're going to do another experiment like the first one, but we're going to add the fact that when our interest rates fall, that's the blue line in the left panel, that pushes down other interest rates, the blue line in other countries, the blue line in the right panel. In comparison to the previous experiment, the red dashed line where nothing happens. Now, once we add those financial spillovers, if you look at the top right panel, foreign GDP now rises materially above baseline, reflecting that domestic demand effect from the spillovers. And that in turn leads U.S. GDP, blue line in the top left panel, to even be higher than it is before. So it's very much a win-win for the global economy. Now, this is all a rather technical way of suggesting that U.S. QE is not beggar thy neighbor, but there's a non-technical view that's pretty straightforward. The U.S. economy is a very important part of the global economy, and then obviously actions that make the U.S. economy stronger will then spill over to the global economy more generally. And I think some similar considerations can apply if we think about the effects of QE in the euro area. Here I've again identified the three channels we're looking at. Clearly, spillovers from euro area QE will be most positive for the global economy if there is a large domestic demand effect. And that's something that I look forward to my colleagues on the panel talking a little bit more about. I don't have much to say about euro depreciation as a result of these policies, except to note that in the United States it has not been a particularly prominent effect of our QE. And then finally, I do want to spend a second or two talking about the financial spillovers channel from ECB QE, because that's something that's been rather topical lately. As you know, a lot of attention being garnered by the huge decline in global interest rates all over the world. People aren't sure why that's happening. Part of it could be expectations by the markets of QE by the ECB. Now, I don't have time to go into all the details of some calculations that I'm going to show you, which are, however, I think in your folders. But basically, I did an extremely rough back-of-the-envelope calculation where I first calculated what the impact on German interest rates might be of the ECB's QE program. And you can read this for yourself. But the bottom line is that it might be on the order of reducing German yields by around 50 basis points. Okay? With that 50 basis point reduction in German yields, the question then becomes, well, what's the spillover to other economies? That's very tenuous. I've established a range here, like basically a tenth to a half as a spillover from German yields to other major country industrial yields. If it were at the half level, that would suggest that interest rates in the States and elsewhere have fallen maybe by 25 basis points as a result of expectations of those policies. That's a material amount. On the other hand, it accounts for only a small part of the overall decline in global rates. So now I want to loop back to the two questions that I posed at the beginning of the talk. First of all, will QE and the ECB, and perhaps Bank of Japan, complicate the task of normalization among those economies that are going to be tightening at some point? And I don't think so. As I've now described, the spillovers from QE are complex and they tend to offset each other in large part. Moreover, to the extent that there is a net positive or negative effect on other economies from QE, central banks can adjust their normalization strategies to be slower or faster in response. The second question I raised is, well, when the US, UK, and other economies start normalizing, is that going to substantially impede the effectiveness of QE in those still easing economies? And again, I'm somewhat sanguine about that. I don't think so. When the normalizing economies do start normalizing, it's going to be in the context of solid, sustained growth on their parts, and that's going to be good for the euro area. Moreover, this normalization is going to be very well communicated by my colleagues like Mr. Rosengren here, and as a result, it shouldn't engender market disruptions. So, bottom line, to wrap it up, as you might be gathering, my attitude toward these things is that when central banks pursue policies that are good for their economies, that probably will end up being good for the global economy too. Thank you. I'll stop there.